automatically equates to bullish institutional positioning.
We are no longer talking about, you have likely noticed a profound distinction, but the aggregation of those two categories.
Pricing, but the underlying reality is that this survival strategy is built on a highly specifically, they are withholding shares to satisfy.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
It is March 8th, 2026. And if you have been watching AMC Entertainment Holdings over the last 90 days, you have likely noticed a profound shift. The entire trajectory of the company has, well, completely detached from traditional business metrics. We are no longer talking about box office receipts or concession sales or theater foot traffic. What we are actually observing, if you read the Securities and Exchange Commission filings carefully, is a highly complex, aggressive series of capital structure and refinancing actions. The central question we have to grapple with today is, how to interpret these massive market maneuvers. From my perspective, AMC's recent actions, specifically their comprehensive efforts to extend their debt maturities out to 2031, along with their active engagement with major institutional players, they demonstrate a highly successful, proactive approach to maturity management. They are systematically dismantling their near-term default risk and basically buying the company the time it needs to survive.
Well, I look at the exact same Edgar filings and I walk away with the fundamentally different conclusion. Where you see proactive management and survival, I see maneuvers that expose severe execution risk. And quite frankly, they guarantee massive, permanent equity dilution for shareholders. Furthermore, I would argue that the reported institutional buying, which has driven so much of the recent market narrative surrounding the stock, is a structural illusion. It is a byproduct of complex financial engineering rather than a demonstration of genuine, fundamental conviction in the company's underlying operations.
Let us break down exactly why I see this as a master class in shifting the debt timeline, because the mechanics here are crucial. The centerpiece of this entire strategy is the financing plan that AMC disclosed on February 23rd. We are talking about the commencement of a massive offering. $1.73 billion in first lien notes due in 2031. This is operating right alongside an expected $750 million term loan facility. Now, for anyone looking at the balance sheet, the stated intent of this cash raise is absolutely critical. AMC plans to use these proceeds, combined with cash on hand, to aggressively redeem $400 million of the Odeon notes due in 2027.
And we should clarify exactly why they are targeting those specific Odeon notes.
Right, exactly. Those Odeon notes carry a highly burdensome 12.750% interest rate. In the world of corporate finance, a nearly 13% yield is a crippling cash drain on a company's operations. By taking out that expensive near-term debt and pushing the maturity wall all the way out to 2031, AMC is providing itself with immense operational breathing room. It is like pulling the aircraft up just before hitting the trees. Furthermore, when you look at the Schedule 13G filings within this specific 90-day window, we are seeing major institutional presence backing this up. UBS Group AG reported holding 6.2% of the company. That translates to over 31.8 million shares as of December 31st. Discovery Capital Management reported holding 6.0% or roughly 32.7 million shares. To me, the numbers in the filings back this up. This is clear evidence of AMC's ongoing ability to attract major capital market participants. They are effectively managing a highly distressed capital structure.
I understand why you frame it as pulling the aircraft up, but we really need to examine the fuel it is costing them to perform that maneuver. You are highlighting the debt extension while entirely glossing over the massive, ongoing equity dilution required to achieve it. Let us translate what these filings actually mean for the existing shareholder base. Take the January 29th letter agreement with the 2029 note holders, for example. In order to simply amend the indenture, literally just to give AMC the flexibility or the permission to attempt to refinance the term loan and those Odeon notes, AMC had to agree to a consent fee. That fee is payable in common stock, up to 17,806,866 shares.
Subject to a trading price-linked reduction mechanism, to be fair.
Yes, subject to market pricing, but the underlying reality remains staggering. They are not just tweaking their debt. They are buying survival with their own equity. They are essentially handing over nearly 18 million shares as an immediate overhang just for the right to attempt a refinancing. The insight here is that time is their most expensive commodity, and shareholders are footing the bill. And regarding your point on institutional ownership, we have to read those 13G filings with strict precision, not just headline numbers. You mentioned Discovery Capital holding 32.7 million shares, but if you read the fine print of that disclosure, it explicitly notes that over 27.1 million of those shares are issuable upon the conversion of a convertible note.
Which is a standard financing instrument.
It is, but it completely changes the narrative. Discovery Capital is not just buying 32 million shares on the open market because they believe the theater business is booming. They are holding convertible notes, which is debt that can turn into stock. And in these scenarios, funds often short the common stock against the convertible debt to lock in a risk-free yield. That is convertible arbitrage. It is a structural hedge, so calling it institutional backing creates a structural illusion of bullish conviction that simply doesn't exist in the way retail investors might assume.
Okay, let me pause you there because I think we are looking at two different sides of the same coin. I see why you emphasize the arbitrage mechanics, but let me give you a different perspective on the execution itself. Yes, there are steep costs to unlocking these capital structure maneuvers, but when you are dealing with a complex corporate turnaround of this magnitude, stabilizing the maturities is the absolute prerequisite for survival. The February 23rd disclosure shows a clear, actionable path to taking out those 2027 maturities. And while you might focus heavily on the consent fees, the fact that lenders are actively engaging in these indenture amendments, like the February 25th supplemental indenture for Movico LLC regarding the 2029 notes, it shows a fundamental willingness from creditors to actually work with the company. The creditors are not forcing them into Chapter 11. They are sitting at the table and successfully negotiating the flexibility AMC needs.
But you have to ask yourself how fragile that position is. I hear your point about creditors staying at the table, but the path to taking out those 2027 maturities is entirely conditional. The market reality treats this massive refinancing as planned, but absolutely not yet done. Look closely at that February 23rd filing regarding the Odeon Cinemas Group. They delivered a notice of conditional full redemption to the holders of the Odeon notes at 103.188% of principal. The premium is nice, but the operative word there is conditional. It is strictly contingent on completing new debt financing transactions that meet a stated gross proceeds threshold. If AMC cannot raise the new money, the old 2027 notes are not redeemed. The aircraft does not pull up. And we know the execution uncertainty is severe because on March 6th, AMC had to disclose an amended and restated commitment letter related to these exact financing plans, updating the timing and conditions. In the world of syndicated debt, constantly extending commitment documentation signals ongoing and likely highly difficult lender negotiations.
Wait, are you suggesting that extending a commitment letter for a facility of this size is automatically a red flag? Because I would argue the exact opposite. Extending the commitment documentation on March 6th is a positive display of flexibility. We have to be realistic about the mechanics of corporate debt. Syndicating $1.73 billion in first-line notes is not like getting approved for a mortgage. It takes weeks of wrangling, book building, and complex syndication across dozens of institutional lenders. By securing an amended and restated commitment letter, AMC is effectively reducing the immediate deal expiration risk. Think about it. If the credit markets were entirely shut to AMC, or if the underlying business was viewed as completely unviable, you would not see commitment letters being extended. You would see them expiring. The lenders remain at the table, and as for the conditional nature of the Odeon redemption, that is standard liability management boilerplate.
You simply do not call your existing expensive debt until the new, cheaper cash is firmly locked in escrow.
It might be standard boilerplate, but we cannot ignore the forward-looking statements in their own recent 10-K filed right alongside this on February 23rd. The risk disclosures still contain highly explicit language warning that insufficient additional liquidity could lead to in-court or out-of-court restructuring. That is not just lawyers protecting the company from lawsuits. It frames management's actual stated constraints. The execution risk is the dominant factor of AMC's current reality. They are walking a tightrope where any failure to close these new facilities on expected terms brings the restructuring and potential bankruptcy narrative right back to the forefront.
I acknowledge the execution risk, certainly. Any refinancing of this scale carries closing contingencies, especially when navigating a highly leveraged balance sheet. However, the fact that they are executing these supplemental indentures, take the January 12th amendments to the senior secured exchangeable notes due 2030, for instance, it shows that they are methodically addressing ambiguity in their debt documentation. They updated the definitions, they refined the exchange rate mechanics. These actions, combined with the 17.8 million share consent fee we discussed earlier, are simply the price of admission. They are the standard operating costs required to buy the company vital time. When a corporation is in this specific phase of a turnaround, dilution pathways are a necessary tool. The equity overhang you mentioned is painful for current shareholders, yes, but it is the necessary price for ensuring the company does not face a catastrophic liquidity crisis in 2026 or 2027.
The problem is that a necessary tool has become the entire business model. I forcefully question the underlying health of any equity if survival requires constant structural dilution channels. You call it a standard operating cost. I look at it and see a permanent ceiling on shareholder value. If this refinancing were truly a masterclass that deeply strengthened the company's fundamentals, we would expect to see internal conviction from the people who know the company's financial realities better than anyone else, the insiders. But when we look at the Form 4 insider transactions within this 90-day window, the silence is deafening. There's absolutely no conviction being signaled to the market.
I have to push back on that line of reasoning because we have to consider the regulatory environment these executives operate in. Insider trading windows and corporate governance policies strictly limit when executives can buy or sell stock. When management is actively in possession of material, non-public information, like the day-to-day syndication progress of a $1.73 billion note offering, they're locked out. They are likely in a severe blackout period right now, rendering open market purchases legally impossible.
That is true. Blackout periods are real. But we still have visibility into the transactions that did occur during this window, and they reflect zero discretionary open market buying. Look at the Form 4 filed for Executive Chris A. Cox on March 2nd, or the Form 4 for Carlos C. Chavarria filed earlier on January 9th. These transactions reflect only administrative share dispositions. Specifically, they are withholding shares to satisfy tax obligations upon the vesting of their equity compensation. It is purely an administrative tax mechanism. If the institutional maneuvering and the debt extensions were the fundamentally transformative bullish events you suggest, you would historically expect at least some open market purchasing by leadership, perhaps before the blackout period began, to signal confidence to the retail and institutional bases. We see none of that.
I think it is dangerous to over-index on a lack of insider buying during the complex debt restructuring. Instead of focusing on what insiders are legally restricted from doing, we should look at the massive volume of institutional involvement that is demonstrably occurring in the market. The sheer presence of these large holders implies deep market liquidity and intense engagement with AMC's equity. Even if Discovery Capital's position is tied to a convertible note, or UBS's position is related to prime brokerage, it demonstrates that the primary capital markets are highly active in AMC's capital structure. And this ties into a much larger conversation happening around the stock. There is a persistent narrative regarding off-exchange trading and dark pools, facilitating deep institutional involvement. This massive off-exchange volume speaks directly to the immense liquidity available to the company, which is exactly what they need to execute these equity-linked consent fees.
We really need to unpack that dark pool narrative meticulously. We need to spend some time here because it is arguably one of the most misunderstood aspects of modern market structure, and it directly challenges the assumption of hidden institutional buying that many retail investors cling to. When people talk about off-exchange volume, they often lump entirely different trading mechanisms into one mysterious bucket. FINRA's OTC Transparency Framework is the official regulatory source here,
and it strictly separates off-exchange trading into two distinct categories. First, you have alternative trading systems, or ATS. That is what most people actually mean when they say dark pools, venues where large institutions cross-block trades anonymously. But the second category is non-ATS OTC trading. This is largely internalization. It consists of retail wholesalers and broker-dealers executing everyday retail order flow off the lit exchanges.
Yes, and I understand the technical distinction, but the aggregation of those two categories still represents an enormous amount of equity changing hands outside of the public lit exchanges. Whether it is an ATS, block trade, or a wholesaler internalizing a retail order, that volume matters. It matters tremendously when evaluating how easily AMC can execute its at-the-market offerings, or how easily the market can absorb the equity issuance from these 18 million share consent fees without completely collapsing the bid.
It absolutely matters for overall liquidity, yes, but it does not prove massive institutional buying, and it certainly does not prove hidden accumulation of shares. When a retail investor buys 10 shares on their brokerage app and a wholesaler internalizes that trade to provide price improvement, it prints as off-exchange volume. It is not a secretive hedge fund loading up on AMC, it is just standard retail market mechanics. Furthermore, FINRA imposes strict publication delays on this data to protect market participants. For Tier 1 national market system stocks, which AMC is, the ATS data is on a mandatory 2-week delay. For other OTC stocks, it can be up to a 4-week delay.
Which means we are always looking in the rearview mirror when analyzing off-exchange liquidity.
Exactly. Without having access to the citable per-ticker ATS venue data in real time, which is delayed and highly difficult to programmatically extract for the average investor, assuming that large off-exchange volume automatically equates to bullish institutional positioning is a fundamental misreading of the data. It conflates retail enthusiasm with institutional accumulation.
I see why you emphasize the technical limitations of the FINRA data. And it is true that we must be precise about the delays and the critical distinction between ATS and non-ATS OTC volume. You cannot assume every off-exchange trade is a bullish whale. However, we cannot let the complexity of market structure obscure the plain facts of the SEC filings. The Schedule 13G disclosures are definitive for reported beneficial ownership as of their stated event dates. UBS Group AG reporting 31.8 million shares with shared voting and dispositive power is a concrete fact filed under penalty of perjury with the SEC. It shows that massive global financial institutions are deeply integrated into AMC's float.
But deeply integrated how? That is the analytical pivot point of this entire debate. A 13G filing from a major global bank like UBS must be read in the context of their actual business model. They are not a retail trader buying and holding. They hold positions through client facilitation, managing massive trading books, hedging for swap counterparties, and acting as a prime brokerage custodian. None of those activities represent directional, long-term belief in AMC's enterprise value. And without quarter-to-quarter 13F comparisons across hundreds of different asset managers tracking the exact reconciliation of share classes, options, and derivatives, citing a single 13G to claim institutions are buying AMC is structurally flawed. It only confirms the ownership structure at a single snapshot in time. And more often than not, that ownership is driven by the very debt equitization and convertible instruments we were discussing earlier. It is the plumbing of the market, not a vote of confidence.
That is a fair distinction regarding the mechanics of prime brokerage. UBS is a massive entity with countless moving parts. However, I would argue that regardless of whether UBS is warehousing those shares for client facilitation, hedging a swap, or making a directional investment, the underlying reality remains entirely in AMC's favor. The company possesses the liquidity and the intense market attention necessary to execute highly complex corporate finance transactions. The fundamental thesis of my position is this. We are looking at a company that was staring down a massive, potentially lethal maturity wall in 2026 and 2027. Through sheer financial engineering, they have successfully engineered a pathway to 2031. The $1.73 billion first lien notes, combined with the new $750 million term loan facility, fundamentally alter the survival calculus of the firm.
Yes, they paid a steep price in consent fees, handing over 17.8 million shares to the 2029 note holders is a very real, very painful cost to existing shareholders. But in the realm of distressed or highly leveraged corporate finance, you pay an equity to preserve the enterprise. They are resetting their capital costs. They are avoiding a liquidity trap. They are surviving. That is the dominant, indisputable narrative found in these recent filings.
And my summary is that this survival strategy is built on a highly unstable foundation of contingencies and continuous equity overhangs. When you strip away the sheer scale of the billions of dollars being moved around, you're looking at a company issuing conditional redemptions that may never execute. You're looking at a company extending commitment letters because the lender negotiations are ongoing and difficult. And you're looking at a company relying on convertible notes that incentivize arbitrage rather than long-term investment. The public filings from the heavily caveated 13G forms highlighting massive convertible issuance to the distinct lack of open market insider buying observed in the recent Form 4s, they paint a very distinct picture. It is a picture of structural, survival-based financing, not institutional belief in an operational turnaround. The restructuring language remains explicitly stated in the forward-looking statements of their 10K for a reason.
The risk is still very much alive.
I think where we absolutely converge today is on the realization that over the last 90 days, the true catalysts for AMC's stock and corporate health have been entirely detached from consumer behavior. The box office performance or the success of the latest blockbuster simply do not matter right now compared to the balance sheet.
Exactly. The entire narrative of the company now hinges completely on complex corporate finance, debt equitization, and the nuanced mechanics of market structure.
It is a fascinating case study in how capital markets operate under pressure. We encourage everyone listening to look closely at the primary Edgar filings themselves. Look up the Forms 8K from January 29th and February 23rd, read the annual 10K, and dig into the FINRA OTC transparency documentation. Understanding the mechanics of debt flexibility and market structure is absolutely essential to grasping the reality of the situation.
I agree entirely. Reading the actual footnotes on a Schedule 13G or unpacking an indenture amendment tells you far more than any surface-level summary or social media post ever could. There is an immense amount of complexity left to explore in these materials, and the real story is always buried in the fine print.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!